Good afternoon or evening, depending on where you're joining us from, and welcome to From Complexity to Clarity, Simplifying Decisioning Through a Single API. I'm Matt Tepper, Vice President of Global Marketing at GDS Link, and I will be moderating today's discussion. Today, we will delve into common challenges faced by lending and financing organizations, from increasing volumes and mitigating risk to maintaining vigilance against fraud and streamlining processes. Many in the industry are hesitant to make broad changes in their technology and processes, often anticipating high costs, time-consuming implementations, and potential disruptions. Our goal today is to hopefully dispel these myths and demonstrate that digital transformation is not only accessible, but can also bring about swift and significant benefits. Joining us today are two distinguished experts in the field of credit risk and decisioning. First, we have James McKell, a senior account executive here at GDS Link and a seasoned professional in credit risk decisioning solutions. James brings a wealth of knowledge about the value of such solutions for lending organizations and the uplift they can provide in optimizing underwriting workflows. Welcome, James. Alongside James, we have Nathan Petrie, Global Analytics Account Executive and an expert in data and analytics. Nathan possesses in-depth knowledge of AI, risk models, custom scorecards, and alternative data, and he deeply understands their interplay within a lending environment. Welcome, Nate.
Thank you, Matt.
Today's discussion will be structured into 5 key sections. We'll start by examining strategies for enhancing decision-making and underwriting processes. Then we'll explore the integration of advanced technologies within credit risk management, followed up by a discussion on operational efficiency and cost management. From there, we'll delve into policy management. And finally, we'll conclude with an exploration of how a centralized unified API solution can streamline various credit processes. Before we begin, please feel free to type in any questions that you might have into the Q&A box in your Zoom control panel. In the interest of time, we will address these towards the end of today's webinar. This session is being recorded, and we will make this not only these slides, but the replay of today's session on our website and our social media channels. As we transition from today's introduction to the heart of the discussion, let's focus on how the landscape of credit scoring and underwriting is evolving. This evolution isn't just about adopting new technologies. It's about reimagining processes to better meet the demands of a dynamic financial environment. James, I'll start with you. The lending industry is continuously seeking ways to improve efficiency without sacrificing risk management. What are some emerging strategies that are out there for improving auto approval rates within lending?
One of the things that we're starting to see a great deal of is utilization of more advanced analytics. And so you're starting to see within that the use of non-traditional data sources, using a great deal of kind of policies and theory specifically around non-traditional data sets, so that we can build personalized credit products for the end borrower. So you're starting to see more just the consumption of mass amounts of data from internal and external data sources.
With the increasing role of automation and predictive analytics in the approval process, it's clear that we're at a juncture where technology is not just an enabler, but a driver of change. In this context, a new buzzword among organizations seeking to innovate is AI. GDS Link is familiar with embracing components of AI in its solutions. I know James and Nate have seen firsthand how these AI-driven approaches are reshaping the landscape. James, with the shift towards digital innovation, how is the transition toward AI-driven models transforming the traditional credit scoring?
Yeah, what we're seeing is more scoring accuracy because of the fact that we're actually able to analyze a great sum of data. We're starting to actually have more predictive kind of views on that specific borrower in a case-by-case basis. But we're also able, even though we do have the speed and efficiencies, we're starting to see kind of more of a balance between accuracy, speed, and fairness. And so all of those elements are still at play, actually, as we kind of use more and more of these technologies. And then at the end result of that is you're starting to see more and more tailored solutions for each use case.
So obviously, there's been a bit of rapid adoption of AI-driven processes and tech, but alternative data sources have also emerged as pivotal elements in reshaping how credit decisions are made. Nate, can you speak to the value alternative data is yielding within these decisions and its impact on lending as a whole?
Yeah, I think one of the questions is sort of what is alternative data specifically for the equipment leasing industry. And I think you could kind of start there by answering what it's not. And so anything sort of outside your traditional credit data can be considered alternative data. And we've seen a lot of lift. If you think about the traditional data, it's going to tell you one story. But anytime you can add a differing story, there's different data points that are giving you elements that may be missing from that traditional credit data. We find that it's in some cases significantly additive. So you may have exponential performance improvement by just adding in some other alternative data like utility payments or some of the trade type underlying data. I think where alternative data really is not as valuable as maybe where the initial thought, some of the social type data is not quite as predictive as maybe firmographics on a business, or like I said, some of the trade type data. How are they paying on some of those type obligations? And definitely, the concept of that traditional data is you may get a score. Let's say it's a 650 score that includes 10% probability default measurement. Well, if there's one borrower out of 10 that are defaulting, there's some that are not as risky, and the model itself just couldn't differentiate them. So bringing in some alternative data gives you that alternative viewpoint of the borrower, maybe helps separate out some of those riskier borrowers from the less risky borrowers in that same pool. So definitely from a segmentation, risk segmentation perspective, alternative data is bringing quite a bit of lift.
And kind of piggybacking off of that, how's predictive modeling in credit risk management adopting to these changes, this further erasing of alternative data, and what implications does that have on future lending strategies?
Yeah, and I think the question of sort of what is AI for equipment leasing is really the answer to your question. Ultimately, when you get into more advanced credit modeling procedures using things like machine learning, XGBoost, or random forest type models, you're looking at larger data sets and looking for correlations. And a lot of the focus is on how variables interact with each other to create a predictive feature. So I think the modeling techniques that are widely used today, regression models, will be replaced, and we've seen a lot of this coming in the consumer space already. And I often think, if we want to know what's going to happen in small business in the next couple of years, you can look at what's happened already in consumer. And these more advanced models are consuming vastly more data today than they were even 5 years ago. And taking a human element to make sure that your models are not being overfit by AI is a critical component, through that process. But you're really just trying to identify risky applicants, risk components within your portfolio, and ultimately drive a more profitable business. You can approve more borrowers with less risk. That's, everybody wins.
Thanks for that, Nate. As we transition into the next phase of our discussion, obviously it's essential that we address a common concern within any lending organization. Obviously, organizations rely heavily on legacy systems for their core business processes. The idea of a complete rip and replace strategy can be daunting and for many an unfeasible approach. However, the integration of end technologies with existing systems is not only possible, but also becoming increasingly necessary to stay competitive. James, considering the reliance on legacy systems within many lending organizations, how can lenders overcome some of these integration challenges to streamline their customer journeys?
Sure. I mean, and that's a common challenge, right? Not every organization is willing to boil the ocean all at one time. And so what you kind of really call that is kind of, gradual modernization. And so maybe the first step in that process, maybe to kind of limit your number of API integrations to bring in some more data sources. So look for a provider that can actually give you access to more data sources, but actually at the same time, reducing your API connections that you may have. And that's kind of usually kind of the first step in the process, which is usually a limited factor for most organizations are on legacy systems. They're kind of tied to kind of old data connectors. And so they're not able to take advantage of the new connectors. So that may be the first step. Then, once you do have those kind of integrations in place, then we can start looking at the customer journey and look at that, kind of the steps that are kind of the first part of that customer journey and removing some of that friction, because that's really the key. And then once you're able to kind of start establishing that aspect, then you can start going after the kind of more nuanced pieces of the business and kind of do it more of in a waterfall fashion.
Thank you, James. Innovative solutions such as AI, advanced data analytics can be integrated seamlessly into existing infrastructures, offering new enhancements, not necessarily disrupting some of these foundational processes. This approach allows organizations to obviously improve the customer journey, decision making without the need for complete overhaul. But building on the theme of integrating these advanced technologies, Nate, in what ways can AI integration specifically in lending and leasing processes?
Yeah, I mean, it's really the sky's sort of the limit when it comes to integrating AI. Now, everything that AI does or can do, I think, at this point, a human could potentially do. It just does it faster, and you could have it running continuously. So if you think about your scores, they may be rebuilt in this industry. Most of the folks that I've spoken with, they're rebuilt 5 to 7 years. Using AI, there's really no reason you couldn't rebuild models on almost a monthly basis. You see certain areas are sort of degrading. You can make those adjustments without having a whole team of data scientists sort of running Excel files and trying to understand the data. AI can really help illuminate issues and challenges with both your rule set, some of the data sources that you may be purchasing, and your scores that you're ultimately using. How predictive are they? Are there certain things that are maybe losing value? Or is there an optimal way to process a loan? Thinking about optimal, right, saving cost on data. James mentioned having sort of agile waterfalls that are going to pull the right data at the right time. That is a very cumbersome exercise to do and monitor manually, but using AI, you can sort of have the computing power do most of the heavy lifting, so you can make your business decisions much more nimbly, quickly, and in response to what you're seeing from a business side. So I think it just makes it faster.
Sorry about that, Nate. Didn't mean to cut you off there. It seemed like we were kind of segueing to our next kind of copy point here. Obviously, I think from our discussions, we all recognize that the importance of data consistency cannot be understated. Was hoping you can maybe level set a little bit as to how data consistency can help contribute to effective lending decisions.
Yeah, one of the best sort of terms that I've heard in my career is garbage in, garbage out. Right. Ultimately, the data that's driving your rule sets, your credit policies, the data that's driving your scores that you're using in your policy, ultimately the value that it brings is in the data, how consistent it is and how predictive it is. So, certainly there's data that you're using in probably most of the organizations today that may not be appropriately positioned. So what I mean by that is, I built a lot of scorecards for clients, and in that process, sometimes there's a very predictive element, but ultimately it only shows up 5 or 10% of the time. And it may make more sense in that case to put it into a rule rather than include it in your scoring models or your scorecards. So, definitely one of the most critical features of anything, analytics or decisioning related, I think, is reliant on the data being accurate, consistent. And I've, seen firsthand kind of some of the cause an effect of data inconsistency. It could cost you quite a bit of money if something is wrong with what you're receiving from a bureau, for example, which I've seen in the past.
Thank you for that, Nate. So we've obviously explored and kind of examined the importance of the integration, the importance of integrating AI, and the importance of data consistency within processes. This brings us to a crucial aspect of how these advancements are really starting to play out within lending, and more specifically, how they're reshaping underwriting processes. James, how do advancements in decision making, particularly within approval rates, AI integration, contribute to the modernization of underwriting processes?
The biggest change is efficiency and speed. And so when you kind of look at, AI powered systems, they're able to auto decision or auto decline individuals within a matter of seconds, and they only improve over time as they continue to learn. So really the biggest impact there is, the ability to actually, make those effective changes in a timely manner, and also reduce the amount of overhead that would take to produce, maybe one application. So it allows teams to scale without actually having to, throw additional resources at any type of, application or book of applications.
And switching things back to the analytics data side of things, Nate, in what ways does the use of alternative data, predictive analytics, help redefine underwriting strategies?
Yeah, I think a good salesperson could sell you data that maybe isn't even needed for your process, but ultimately analytics, understanding the data, running exercises, running retro analyses, looking at existing underwriting practices and how a new set of data or some of the existing data perhaps that you're reviewing, how does it really help you? How is it really helping to segment your portfolio from a risk perspective? Is it really additive? That's where I think running exercises through an analytics project ultimately helps you identify those data sources that do give you additive lift, and then you can make the assessment. Right, we're paying for this value. How much? What does that ratio look like? So as you're evaluating new data sources, you can't go off of somebody's word. You really should look at it from a data perspective, run some advanced exercises to see how it would impact your approval rates, your default rates, your fraud, those types of things.
And Nate, I know from our preparation for this that you were you're very dead set on making sure that we at least introduce the concept of dialing the dial within underwriting processes. Hoping you can maybe provide a little bit of color around that concept.
Yeah, it's something I didn't create. So my mentor, and I would always sort of talk about having the ability to adjust your credit policy on the fly. So what I've seen in this space in particular is a lot of times you're sort of in a rigid environment. Your scores, if you're using, maybe are off the shelf. You don't have a ton of flexibility. So when things like what we've seen over the last 12 months and increased defaults start coming through, it's difficult to be nimble and to be able to adjust your credit policies, maybe change cutoffs. Is sort of the easiest thing and maybe all we can accomplish. But being able to be nimble when shifts are going to come through, both from a business perspective, you may have business policies, you have new management directions, you may have market changes, you may go after new markets. And in any of those cases, what you have today may not be optimal. So being able to stay on the pulse of your underwriting and be able to make those adjustments as needed when you do see or notice any degradation in any of those areas or different business direction. Having a system and having a model or a credit policy in place that you can make simple adjustments and understand what those adjustments mean to the future of your business, I think is critical. And it's often an area where companies are flying a little bit blind. And so, you have a gut feeling that changing it from a 650 to a 660 might keep you above water. Ultimately, making that change may be a challenge if you're not supported with systems and data.
Thank you for that, Nate. So obviously, with all this with the discussion that we've had thus far about integrating these new technologies and capabilities, and how how that will lead to different levels of advancement within processes, specifically within underwriting and modernizing those processes. It's clear that that within the evolving lending landscape, that this new tech data insights, it might be redefining how risks are assessed and managed. So hoping that we can now kind of shift our focus to how these technological enhancements are influencing the approach to policy management within lending. James, considering your insights on the integration of advanced technologies earlier, how can dynamic credit policies help lending institutions better adapt to market changes?
Yeah, I would say that, any type of dynamic credit policy is really going to be driven by, real-time data analysis. So, an organization wants to be able to make decisions based on not only, current market conditions, but also customer behavior activities as well, those patterns. And so by able to actually, and it kind of goes back to kind of turning the dials kind of based on those market conditions, or we see kind of predictive behavior that's occurring within our population, we can actually go in and actually make adjustments. So that really the key is being nimble. So as we do run across, those kind of changes and kind of, the assumptions inside of the models, maybe we actually go in and actually make those changes in real time versus kind of wait, more being a reactive type of position. So it's really kind of staying in front of, those market conditions and customers.
Yeah. So obviously being able to be malleable to, some of the macroeconomic conditions, as well as like your own customer base, obviously important to, again, remain agile. But maybe, can you talk to our audience about some of the benefits of a flexible approach with policy management?
Probably the biggest element is the, competitive advantage, right? The organizations that are able to make those market changes tend to have, much better success within their loan book, right? Organizations that, and a good example of that was, probably the most significant, kind of event that we have all experienced was COVID. And so, there was organizations that kind of were in front and kind of saw what was kind of coming based on the, not only the market conditions themselves, but also the change in consumer behavior. Organizational behavior. And so in one example, we had a client that, in that March of 2020, made over, I think it was like 120 policy changes in a week's time to get out in front of what was kind of coming. And it was actually a very good, kind of barometer of what type of changes the organization needed to make to protect their loan book. So it was that would probably be an example of organizations that really need to be nimble and kind of staying out in front as best they can to these type of changing conditions.
Thank you for that, James. So with this in mind, obviously evolving technologies, policy adoptions within lending are deeply interconnected. It's not just about the changes themselves, though, but also understanding the extensive impact that an organization that it might have on an organization's data management and their analytical models. Considering this connection, Nate, can you discuss the significance of having a dedicated partner to help navigate these policy modifications and the wide-ranging effects they'll have?
Yeah, it's sort of, it's best practices within an organization, are narrow and limited to what you're experiencing, and potentially maybe at an ELFA conference, for example, you talk to some folks. But ultimately, a third party like GDS, we see what everybody's doing, and that's outside of even equipment leasing. And we see some of the things that maybe other folks are incorporating that are potentially missing as we're going through an engagement with the client. And sharing those best practices really accelerates the process of digital automation. In essence, you can take from the learnings of some of your peers and apply apply things so that you avoid some of the pitfalls. I think that's it's critical, and it's also it's something that's oftentimes missed. You end up sort of keeping your policies close to heart and making decisions internally with what data you have, in-house. And so I'd encourage you, everybody to try to talk to folks that do work across multiple clients, portfolios, multiple industries, to get a sense for some of the newer things, or maybe some of the neater adaptations that folks have made to get a competitive advantage. So I think it's definitely a big driver for some of the lift that you can receive.
Thank you for that, Nate. So obviously we've discussed the role of data and risk management, but now let's pivot to understanding how GDS Link solutions specifically are designed with decision makers, business users in mind, by utilizing a centralized, unified API to help bring these innovations to life. James, let's dive into how a unified API approach can streamline some of these technologies and functionality we've discussed today. How does a centralized unified API approach future-proof operations for organizations?
Yeah, what we found that there's a large number of data providers that can electronically provide some of the work that we're currently doing. Traditionally has been done in kind of manual processes, and by actually deploying more of those. And so in our case, we have over 200 connectors. And so with those connectors, we're able to in using those in tandem, we're able to eliminate some of the manual steps that might typically occur. And using some of those are very unique. Some may be specifically around fraud and maybe open banking. But by deploying those, you're able to actually streamline your operation. So you kind of remove some of the overhead that traditionally would be in place, actually having to manually kind of go to and pull a lot of these data sources. But also at the same time, as we're actually streamlining these operations, we're actually reducing that kind of manual kind of input, which will allow us to scale. So it gives us the capability to centralize, simplify, but also scale at a means we would never possibly been able to do, because of the fact that we kind of remove some of those manual blockers that were traditionally in place. So it's a significant, lift for an organization that sees that, they're looking for a growth pattern. And one way to do that is really simplifying all of those various data sources and the processes to utilize those.
And one that you touched on, James, I think super important is really the ability to really streamline a lot of data management. So shifting our focus to the utilization of data in this integrated environment. Nate, can you speak to how a centralized API can really simplify the ability for lenders to ingest new data sources, scorecards, new models?
Yeah, I mean, I think, one of the challenges that I've seen in the sort of the software side is in deploying scores and in deploying new data sources. So as you look at what data is predictive in the scoring and your rule sets, ultimately you need to be able to deploy those new data sources and without a major project. And then the other side of it is being able to actually utilize the data from those data sources. So a lot of times I've seen connectors that are built with data providers, but there's only a limited set of information that was requested up front, and having to go back in a project and add a data field, I think is a common challenge that I've seen. And using a system or a process like what we're describing here, ultimately you take control of the data sources. You don't need IT resources potentially to add the information that you're looking to add, or make simple changes and potentially turn off a data source for certain aspects or certain segments of your business. So it all kind of goes back to being able to sort of be nimble and adjust credit policies, adjust the data sources that you're leveraging today in a simple, straightforward manner, that you're not paying 5 figures to make that connection with the data source that you need and you see value in. So it takes some of the value discussion and the costs associated with that out of the picture in the future.
You touched on it a little bit there, Nate, but I was hoping you can maybe expound a little bit further on how a unified API can help contribute to really kind of embracing a dynamic policy management.
Yeah, I mean, so, I think the way that GDS has positioned itself is everything from data to decisions that are made, simplifying that process. And ultimately, what I see today is it's not simple for a lot of the companies that are in this industry. And the dynamic, or as you may have heard, agile type waterfall scenario may not even be possible in your environment today. So if you have one API that you have to work with that provider to build out, and the rest of the data and your credit policies and your scores are managed sort of internally by business type users, I think that's a huge advantage in allowing that, going back to just being nimble, being able to dial the dials appropriately. Ultimately, you need control of your data, you need control of your policies, and I see a lot of times it's not in the control of, the credit team, or and oftentimes it's out of the control of the actual organization, and having to go to, one of your software partners to make a simple change, which could take 6 months. And that change that you needed 6 months ago, it's not a problem anymore potentially, right? And so you sort of miss the boat by waiting.
All right, we've obviously covered a lot of ground today. Now it's time to hear from you all, our attendees. Whether you're seeking clarification or further elaboration, please feel free to ask any questions you might have or share your thoughts. Again, if you'd like to type in a question, the Q&A button on your Zoom control panel should allow you to submit any sort of inquiry you might have. We already actually have a couple in the hopper here. I think this first one I'll pose to you, Nate. How do these AI-driven models adapt to the uniqueness of the equipment leasing industry?
So, the AI, just to maybe dispel some myths about AI, AI is basically doing number crunching. It's statistically trying to predict whatever it is that you're plugging into it, right? And one of the common components of AI, today that we probably all are aware of, is some of these large language models. And ultimately what they're trying to do is predict the likelihood of a word being the next word. So it's not like there's somebody behind the scenes that has trained it how to speak in your language. Rather, it's using statistical modeling. And so applying that same kind of mentality, ultimately, AI in credit scoring, it's picking up on nuances. It's picking up on, it's leveraging large amounts of data. It's going beyond what you may look at in a regression model, and looking at comparing, how things compare and contrast within the data. So, your features may be combining 3 data sources into one variable, because that combination ultimately provides a lot more lift. And, as humans, there's sort of only so much we can look at, and so many numbers we can crunch in a day. Whereas some of these AI models, their capabilities to ingest all these different stories and make sense out of them is far more advanced than, sort of what we can do kind of thinking through things typically. And so, not to, remove the human components, because I don't think anybody in lending today, at least I've never heard of anybody who's letting models sort of run just on AI, right? They're not like letting a computer update a model when it sees an issue. There's always a human component, and you're taking common sense and lending practices and applying some of those to the AI models that you're developing. And so, I think when you hear the word AI, you kind of think, is there like a robot that's making decisions for you behind the scenes? And I think it's not quite what you may envision. There's a lot of common sense type components that are brought in through a appropriate modeling process. So, the expertise of your team and of a team like GDS on our data science side, ultimately that helps whittle down overfitting of models and whatnot. So AI is not completely self-sufficient, I think is my point there.
Thank you for that, Nate. One more question for you. Can you discuss or even share some examples on how custom scorecards have been tailored to diverse leasing portfolios?
Yeah, I think segmentation is key, right? That's sort of everything, and I've seen a lot of times you're going to look at new customers differently than existing customers. You may have specific industries or collateral types that drive different loss given defaults. And so as an underwriter, a lot of the data that you're receiving is helping you understand probability of default, but you're trying to convert that into a loss metric. And so in essence, applying different waterfalls that can be both in your scorecards or in your rule sets. You may have a separate scorecard or a separate score, as I mentioned, for new or existing. You may have different verticals that you operate in. You may have different even regions, depending on kind of your parent company might not like you separating by region, depending on who you are. But ultimately, the segmentation I think is a key component of being predictive and having a robust predictive score.
And I'll pose this next one to you, James. Regarding advancements in auto approval rates within equipment leasing, how does this affect the turnaround time for lease approvals?
Yeah, definitely. So, one of the kind of the key elements for the quick response is being able to assess that data in automated fashion. So quick input, multi data sources, and actually put them inside of a strategy that may either waterfall those data sources and possibly allow you to rule a prospect in or out instantaneously. Greatly improves, of course, that turnaround time, because we're removing maybe that part of the friction it might be in maybe receiving hard copy documents or some other type of data that would take rekeying inside. So really, that's the automation that would come from utilizing a lot of those API connections as well.
All right, thank you for that. Now, again, if anyone has any questions, the Q&A button on your Zoom control panel, feel free to submit these. We have a couple more come in. First one, it seems like we're now pivoting to a lot around GDS Link solutions specifically. Is there a feature, I'll let either one of you guys take this, is there a feature within GDS Link solutions that allows for the rescoring of existing customers based on updated or additional data inputs? How seamless is this process?
Yeah, so one of the features that our system has is account management. And what that allows you to do is to kind of continuously evaluate existing customers. And so many organizations will use that to possibly, provide additional lines, maybe upsell, cross-sell. And because we can multi-segment a lot of the different client flows or customer flows, we're able to run, different credit policies, pull in different data sources, all from an existing population of existing customers. So that, and those type of things happen in real time in the background. So they're just running on a continuous basis, pulling in the appropriate third-party data for that reassessment. And so in many cases, it may be running, credit bureau data again, or maybe in some cases we're using open banking data. So we're kind of doing live in real time, cash flow analysis of those customers to maybe extend, additional lines of credit to them. So that's one of the key aspects of our platform to really allow you to monetize your existing customer base.
All right, thank you for that, James. Next, maybe I'll pose this one to you, Nate. A little more of a broader question. To what extent does GDS Link leverage AI-driven technologies within our solutions?
So, I mean, AI is native in everything that we produce, everything that we do here. We do quite a bit of, regression modeling as well, logistical regression, sort of the standard approach. We also, so it's not everything that we do, but if you think about, what does sort of AI mean for decisioning, it's really helping to manage your rule sets, understand which are important, impactful, which are costing you money that aren't giving you a lot of value, and for your scores. So anything that's going into a score that you're producing, you may have 5 data sources helping to produce a score. Keeping a pulse on that and understanding not only at development, is it predictive, but month after month, as time goes by, we use machine learning and software to streamline that monitoring. So I would say it's highly ingrained. It's not everything we do, and it's a little bit of a case by case. How much, from an automation perspective, are you looking to accomplish? But I think it helps you get there. It helps you make decisions faster in most cases. It helps you have a good sense for how predictive a particular score is, so you have a certain level of reliance on it. In many cases, you're using AI and you still may have a portion are manually decisioned, but that AI component helps to flag the appropriate aspects of an applicant that you need to dig into, or maybe ask questions about if you have direct contact with the applicant.
Thank you for that, Nate. James, might direct this to you. Could you shed some light on how GDS Link's platform comes to implementing and modifying those credit policies? I know we spoke about the example of one client, 120 policy changes within a week. Maybe kind of shine some more light how GDS's platform really kind of plays an integral role in modifying those policies.
Yeah, one of the things that we've done over the various updates to our systems, going back to 2006, is creating a user interface that is really designed and built for the business user. And so one of the things that we really kind of really hang our hat on is the fact that a business user, as long as they have, capability to work Excel, they're able to go in and actually manage their credit policies. And of course, there is, user level controls as well as tracing of all changes within the platform itself. But those individuals are able to go in without intervention from technical resources or even from our side to be able to go in and make changes to policy. Maybe they want to change part of the rule set, or kind of going back to the example of COVID, go in and actually make a lot of different changes to that credit policy without having to intervene with other organizations or individuals coming in to assist that. So the biggest element is really the no code element of our platform allows those users to go in and make those changes whenever necessary without any intervention, which is really a key element.
Yeah, thank you for that, James. Glad we really got the opportunity to kind of shine some light on how intuitive and user friendly our interface is. So yeah, thank you for shining some light there. Our last question is, and I'll pose this to either one of you guys. Can you provide a specific example of how subprime lenders are employing GDS Link's services?
I could take a stab, and James, if you want to add any color, but I think from the subprime perspective, we've got a lot of our clients using us for both on the modeling side. So we build custom scores, custom models to help with understanding response rates. A lot of times in the subprime space, you're doing a lot of pre-screen marketing. So we build models starting at that side of the house. Help to select the right leads, then taking that into credit decisioning. We ultimately help build scores that help differentiate risk, help identify fraud, and in the subprime space, risk and fraud are very large components. As you may, you're really trying to understand, as I mentioned kind of earlier, right? Let's say you have a 10% probability of default on a pool of borrowers. Well, there's at least 1 or 2 out of 10 that are probably significantly lower risk. So, you know, can you use software and can you use models to segment and separate the risk a little bit better? And ultimately what that is going to bring you is, you know, being able to make those decisions quicker with more confidence and to help automate some of the decisions. Because I think today in the subprime space, it's heavily automated, and, you know, you're getting, you know, potentially close to 100% auto decisioning rates in that space. And GDS is a great platform to enable company to be able to process everything in an automated fashion. And so, you know, using data to validate and verify assumptions, I think is one of the key areas where our software, it's a sort of natively baked in there. You can run benchmarks and change policies and run data through without having, you know, a major exercise with IT and gathering the data, sort of all just natively built in there. So I would say, you know, subprime is unique in certain areas in that they're highly automated. They're really trying to whittle down to the lowest risk customers and high risk populations. And so they're almost more advanced in most of these areas than other lenders. And, you know, we work with, for example, like 8 out of the top 10 online marketplaces. And those companies are going to deal with a lot of the, you know, subprime, because they're going to decide, you know, do you send it to A borrower, B borrower, A lender, C lender, and ultimately, you know, processing all the data, processing multiple credit policies, having segmentation trees that drive data pulls and drive your different scores, having more robust rules for this borrower than, and, you know, this borrower who's maybe lower risk, right? All those capabilities at your fingertips as a business user, I think is, you know, the advantage that a company specifically in subprime, they're taking advantage of. Because you do have to be more nimble there. You could have a wave of defaults sort of come in a lot faster. And your loss levels in subprime are typically higher than in prime. When you do experience a default, you typically lose more. So we just one quick more addition, and then, you know, James, please add color. In the subprime space, you know, there's a lot of first payment default / fraud evaluation that's going on, and you know, fraud's a tricky subject, right? There's different types of fraud. There's different ways that people might not even think of themselves as defrauding you, but ultimately giving you kind of some fake information. So how do you manage for fraud, and that early term risk is one of the key areas I think that we try to focus on when working in subprime space. It's really, you know, those early defaults are what really hurt you the most.
Yeah, to piggyback that, one thing that I would say is the fact that our customers can really lean on the, you know, multi-decades of expertise, primarily, you know, working with, or, you know, in the subprime and near prime space is definitely kind of a benefit that we're able to provide to our clients. The other piece of that, and really kind of goes back to the single API connectivity of our 200 data connectors that we do have. Several of those are, you know, uniquely positioned to really provide a great deal of detail. And some of those come from your traditional credit bureaus, but you look at your factor trust and your clarity provide you, you know, different elements that you would not typically get in an average or a typical credit file, along with using credential and non-credential open banking data. Using the combination of those various sources allow us to create a great deal of lift specifically targeted, you know, to the subprime market. So I would say those elements, in addition to, of course, the, you know, the decades of expertise, you know, really come together to really provide, you know, really strong solutions for our clients.
All right, thank you both, and thank you to everyone that has submitted a question before. We've obviously discussed a lot today, but certainly want to highlight a few resources and exclusive opportunities that we have to offer. First, if you have not done so already, we encourage you to listen and subscribe to the Lending Link, GDS Link's very own podcast that dives deep into all things lending. With listeners tuning in from now 63 different countries, our latest episode features our host, Rich Alterman, being joined by TransUnion's Sean Flynn to discuss the key trends impacting credit unions and community banks. You can catch this episode and all other episodes on all new listening platforms. Next, I know that both James and Nate have kind of highlighted the importance of trended data and open banking data. We want to make sure that we highlight both of GDS Link's unique custom attributes, which allow for seamless integration and comprehensive views into borrowers' financial behavior. First, our open banking attributes unlock the full power of trended and transactional data through 1,000 standardized policy and model-ready attributes, enabling you to elevate your credit and fraud risk management modeling, yielding new insights like spending patterns, share of wallet with data that has been carefully aggregated, anonymized, and de-identified. GDS Link's credit attributes are comprised of 7,000 normalized attributes from U.S. and Canadian credit bureaus, enhancing your understanding of borrowers' creditworthiness and providing a holistic view of their credit profiles. Regardless of the credit bureau being used, the attributes are standardized, ensuring consistency and ease of integration across different data sources. Both sets of attributes offer substantial savings, improved model performance, and fresher insights, and we are offering an exclusive 90-day risk-free trials of both attribute set. You can find out more at gdslink.com/open-banking-attributes or gdslink.com/credit-attributes. Once again, want to thank James and Nate for today's enlightening discussion, and a big thank you to everyone here for your attention and participation. If you have any questions or if you're seeking additional resources, please don't hesitate to reach out to us directly or at insights@gdslink.com for more information. We hope today's session has provided you with actionable insights and strategies that you can apply to your own context. Again, today's slides and replay of today's session will be distributed out to all attendees later this week. Thank you again, Nate and James, and hope everyone has a great day.